It was another ugly day on Wall Street as we saw all four equity indices to the downside to the tune of 1.5% to 2% depending on the index. Things are getting so extreme that we're starting to see a lot of oversold cluster signals appear, not only on the daily candle charts, but also on the weekly candle charts, which is much more rare, especially this time of year. It's very uncharacteristic for us to have this ugly trading action around the holiday season. In fact, so far, this has been the worst December on record for the stock market since the 1930s. So, are there opportunities out there? Perhaps. We're going to look at one stock here today that's been clobbered based off of some news stories in recent days, and we're going to see if there's a selling of a put opportunity there for us to perhaps lock that stock down at a cheaper price going forward. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 20th, 2018. First of all, if you're new, welcome aboard. We're grateful to have you in our audience tonight. Remember to subscribe to our YouTube channel, and while you're doing that, check out our description area where you can also sign up for our email distribution list that not only alerts you to whenever we post these videos, but also gives you a heads up on what stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee. Make sure you're following me there. Feel free to click like and retweet on these Market Outlook related tweets that we have as well if you want to give us a heads up that you're enjoying them and get value out of them. And lastly, we do have a presence on Facebook. Make sure you're joining us there at the web address embedded in the logo in front of you. So with that, let's go ahead and dive into the charts. As you can see here, I've got chart 4B pulled up. And as a reminder, we're looking at 3-month charts in this particular case, and there's 4 different charts here. The one in the upper left is our S&P 500, the one in the upper right is the Dow Jones, the one in the lower left is the NASDAQ Composite, and the one in the lower right is the Russell 2000. Now, one thing that is interesting here today is notice all these pink labels that show up. That's somewhat unique because they only show up on days where we're hitting a new 52-week low. Now, we had that conversation in the fall and in the summer when those labels were green, and they would show up whenever we would hit a new 52-week high. My, how the mighty have fallen in just a short amount of time. So we've basically gone from all-time highs to yearly lows within basically 3 months at this point. So all 4 of our indices hit fresh 52-week lows here today. Notice that the S&P 500 was down 1.58%. Dow Jones was down basically 2%, NASDAQ Composite down 1.6%, and the Russell 2000 down 1.7%. Notice that all of these labels up here that talk about the daily range are orange, and remember that is designed to alert your eye to the fact that we had an outsized range day. Remember, if we did not have an outsized range day, those labels would be blue. So not only are we plunging to new yearly lows here, we're doing so on pretty aggressive wild trading types of days as well. In addition to that, notice that all 4 of our charts continue to have that bearish posture like I mentioned in the intro. No big surprise there. We've had a bearish posture for quite some time, and so if the stock market keeps on falling, we'll continue to have that posture. So you can see that we have this dark pink posture in all 4 of these charts, telling us that we have that bearish posture because that green line is either falling or in the lower reversal zone on all 4 of these charts. So, no matter what part of the stock market you're looking at, whether it's the mega caps or the small caps or anything in between, it's all ugly out there right now. Now, I mentioned the cluster signals here. So the first thing I do want to point out is that we have cluster signals on all 4 of our charts yet again today. Remember, on Tuesday I mentioned that was the first time in over 3 months that we had cluster signals on all 4 equity indices on the same day. Well, here I am 2 days later to let you know that while that was the first time on Tuesday, we have now done that 3 days in a row because every day since then, yesterday and today, we've also had oversold cluster signals on the daily candle chart. So this is certainly rarefied air that we find ourselves in right now. You can see that where we stand from kind of a year-to-date perspective on the S&P 500 is we're now down about 8%. On a year-over-year basis, it's about the same as well, of course. Over the last 3 months, that's the really ugly one up there, down nearly 16% in just 3 months worth of time. Now, before we kind of move on here, I do want to pull up chart 3A in this particular case, and I'm going to pull up the S&P 500 or the SPX on that. One of the conversations we had today in my question and answer session, which is now posted, so for those of you that are premium market scholars, you're welcome to go to our website, go to our calendar, and listen to that presentation. But one of the things that we were reviewing in that class was the cluster signals of the S&P 500 from a weekly chart perspective, not a daily chart perspective, but a weekly chart perspective. And remember, weekly candles typically have less of those oversold cluster signals than daily candles do. We'll see perhaps a dozen of those from a daily candle perspective throughout any given year, but getting oversold cluster signals on a weekly candle chart is very, very rare. Notice that I've got this 10-year weekly candle chart pulled up right here, and I've got SPX pulled up here. Notice that as it stands right now, this is this week's candle or bar in this particular case. We've got this little dot showing up directly below it. That little dot reminds me that we have a oversold cluster signal where all three of those market forecast colored lines are in the lower reversal zone on a weekly candle chart. Well, the reason I want to show it to you here in this format where it's nice and clean in a white background is so that way we can easily see how rare this condition is. The last time we had a weekly cluster, an oversold weekly cluster, was going all the way back to here, all the way in the lower left-hand portion of the screen, nearly 10 years ago. We had 3 of those weeks in a row, so just be aware of that. Just because we're getting one right now doesn't guarantee that this is the end of the selling onslaught. Perhaps we get a couple more weeks of it. But what I can tell you is that the last time that we did have an oversold cluster signal, it would have been here in February and then the first week of March of 2009. And of course, that should sound familiar because that was truly the end of the last bear market. Had you been doing bullish things with your money at that time where we were getting those oversold cluster signals on the weekly candle chart, you would have obviously benefited handsomely from that decision. Now, there are no guarantees it turns out that way this time around. I'm just merely pointing out that this is a very rare occurrence. Out of all the pullbacks that we've had over the last 10 years, this is the one that has been so far the most extreme and therefore might be worth looking at some valuation-oriented opportunities out there for stocks that perhaps you want to own for the long term. Let's go ahead and get back on track here with a few other charts now. We'll take a look at the 3 green arrows chart here on chart 4C, but of course you guys will know that we still have 3 red arrows here. That was the case here for the last several weeks, and it continues to be the case, so I'm not going to spend a lot of time on it, just a recognition that that is it. If you're looking at trend trades in this type of a market, you're probably having more success finding bearish trend trades as opposed to bullish trend trades. Remember, if you're doing bullish trend trades, you're aided or helped along quite a bit if the general stock market is giving you 3 green arrows. And right now we're getting the opposite of that. Again, no surprise considering the extreme selling we've been experiencing here recently. Let's go over here and take a look at our 1040 crossover method chart. This is chart 4D. And as you can see, we've got bearish crossovers across the board. The last one to go was the Dow Jones, which is this one right here. And notice that this week we are getting our death cross on the Dow Jones. We've, of course, had the death cross on the other 3 indices in prior weeks. The Dow Jones was a little bit more resilient because it's made up of a lot of times, perceived safer names like your, Coca-Colas and Procter & Gamble's of the world. So they tend to hold up a little bit better price-wise when the stock market is really getting massacred. So the Dow was kind of holding out some hope that it wouldn't have a crossover. But as we've been mentioning in recent weeks, odds highly suggested that the Dow would also get a death cross. And indeed, we are seeing that right now. Unless there's some sort of immense rally tomorrow, that will be locked into place. Because remember, these are weekly candle charts that we're looking at here. So technically, there's one more day's worth of activity that would need to go into this candle before we can say that it's guaranteed locked in stone. But at this point, it looks like there's probably a 95% chance that that is going to occur without some sort of immense rally tomorrow. So across the board, from a longer term perspective, we also see bearish posture, not just from a intermediate perspective like we see on those market forecast indicators, but also from this longer term perspective where we look at the 1040 weekly candle crossover system. And remember, we had a very good bullish run along the way. So I know it feels uncomfortable to see the bullish crossover go to a bearish crossover, but we actually had a really good rally, and it's hard to complain with having a bullish crossover occur in March of 2016 and finally getting rid of it now, right? So if we can get those types of runs repeatedly over the years, I think most of us would take them, even if it means we're not going to be getting out at the top. Let's go ahead and take a look at a couple more charts here now. Let's go on over here to our 12 grids, in this case, chart 4E. This will be our intermarket analysis 12 grid. And as a reminder, when we look at the background colors of these charts, it lets us know whether we have a bullish or bearish posture, depending on whether the charts are green or pink, from an intermediate term perspective using that market forecast green line. So as we can see here today, the VIX was up here today yet again. In fact, the VIX hit its highest levels in 3 months. That by itself is not surprising. After all, we hit a new 52-week low in the stock market, so the VIX should be going up. Maybe a little bit more surprising has been the sell-off that prior today did not have a VIX that was above 26. Some of you might have seen me do a retweet on that particular statistic here yesterday. It's fascinating because normally when we get a sell-off this violent, where we're down, 10% across the board in just a few weeks' time, you typically find some immense spikes out of the VIX where there's true panic and fear setting in. Sometimes I think even in February, I want to say we went up to 50 on the VIX. Let me just verify that. I'm going to come over here and go to a 1-year daily candle VIX. And yeah, notice the VIX was way the heck up here. I've got this set up on percentages right now, but I believe that's about 50 right there, about 2 times the fear and the panic that we're experiencing right now. So that's a little bit worrisome. You'd like to think that, with the beatdown that stock prices have had so far, that there would be a lot more people, panicking and freaking out at this moment. And believe me, they're out there. It just hasn't been wholesale, sell all of our portfolio and go to cash and throw in the towel. We haven't had that kind of capitulation type of a move yet, which makes things even a little bit scarier, quite frankly. If we'd be seeing that type of behavior right now, then perhaps we get the sense that, a true rebound is right around the corner. But, at this point, if the market does start rallying a little bit, let's say in the coming couple of weeks, without any sort of true capitulation sell-off, then I think the fear of the marketplace will always have in the back of its mind that we are still due to have that capitulation at some point going forward. And so, it'll be back in the back of their minds. And, every time there will be a rally, it'll be a rally to sell rather than to buy. So anyway, we'll see where things take us. Of course, we're in a very much a news-driven environment right now with trade talks, possible governmental shutdown. Of course, the Federal Reserve is in the discussion. So there's a lot of different things going on right now that can certainly change the trading sentiment on Wall Street. But as of right now, of course, things continue to look pretty dreary this holiday season. As you can see, U.S. government bonds have been one place where you can hang out, although they were down today. They were down 0.36% today on the TLT. But generally speaking, that's a pretty strong trend right there. So, as stocks get sold, money is starting to flow a little bit into government bonds. And then gold. I've been pointing this out here in recent weeks and months, and I've just been impressed with the stability in gold. And I think it's being viewed right now by the marketplace as some sort of a safe haven asset. We haven't seen that same type of resilience that we've seen out of gold in the other commodities like ag commodities here, or even crude oil, which continue to be in downtrends. Notice that even today, ag commodities and crude oil were down. Crude oil was down another 4% today, even though the dollar was down. And that's kind of rare. Normally, all else being equal, if the dollar is down 0.77% today, which is actually a pretty decent sized move for a currency, you would expect that the commodities would be up based off of that. But today we only had gold up, and I don't know if it was necessarily a result of the falling dollar. It was more so gold was getting a benefit, acting as a safe haven, attracting money outside, away from the stock market. Let's take a look here at some foreign charts now. This will be chart 4F. And these will look at stock markets around the world. Now on Tuesday, there was only one chart in the green, and that was India. And I was mentioning how that one looked so impressive. Well, here we are a couple days later. It continues to be impressive. You were actually up today in India. EPI was up 1.93%. That's a pretty significant day, considering the United States suffered as much as it did. Now, Mexico, since Tuesday, Mexico has also lit up a green background chart there just in time for Christmas. And while it's impressive that it's been able to kind of rally back past that downward trending moving average and have maybe a little bit more price stability where we've gone sideways in recent weeks, when I look at those two charts, I do think that India presents the more interesting bullish opportunity there because we have more of an upward ascent in that price action and in the moving average itself. With Mexico, I just fear that may be a head fake where it kind of gives us a few days of upside action, but then kind of sputters again. Until we can turn around this moving average on Mexico, I think I'll be a little bit cautious around that one. But otherwise, as you can see from these charts, it's ugly, ugly, ugly across the board in most of these foreign markets, very similar to how it is here in the United States right now. Let's now take a look at the United States and the sectors within the S&P 500. Actually, I didn't mean to pull this one up, but while we have it up here, I might as well talk to it real quick. This is chart 4H, and this is going to show us the sector breakdown in a slightly different view as opposed to looking at the 12 grid that I normally do. While we're over here, notice this. In the last 3 months, we have one, yes, count them, one sector out of 11 that has positive price performance. And that is this purple line up here. That is XLU, or the utilities. That's the only one that's above this dotted, dark, kind of gray line that we have here, horizontal line. That represents the zero line. So that means that 10 out of 11 sectors in the United States over the last 3 months are down. The worst offender is energy. That's the brown line down here at the bottom. XLE in the last 3 months, down about 23 or 24%. Very, very ugly. So right now, if there is a relative safe haven, it appears to be the very defensive sector of utilities. Real quick on the 12 grid perspective here. Let me pull that up. There it is, chart 4G. This will allow us to see the candlestick patterns a little bit better on each of the 12 sectors that are out there. And as you can see, we've got a clean sweep right now for posture. We have bearish postures across the board. Again, utilities are actually up over the last 3 months, but even that has kind of come under pressure here over the last, let's call it, week or so. Utilities have been down 1, 2, 3, 4, 5 days in a row. So we're still up from where we were a couple months ago, but we've given back a lot off the top even there. But it's a house of pain pretty much everywhere else you look. I mean, things look really, really sick out there right now. The financials in particular, I showed you the graphic of my sector selector on Tuesday where I was showing you all those new 52-week lows with financial stocks, all the banks and the brokers and the insurance companies. I mean, it doesn't matter who you are. If you're a financial company, you're getting blitzed right now, and this chart shows you that from a high-level XLF perspective. We've had 1, 2, 3, 4, 5 straight days of oversold cluster signals on XLF. I'd have to believe that is a very, very rare occurrence in history. And as you look at all those charts there, the vast majority of them have lower highs and lower lows. So again, not a big surprise. Our posture remains bearish at this current juncture. Let's take a look at the sectors on a one-day basis here, just to give you a sense of who was down the most here today and who was up the most. Actually, none of them were up today. Utilities were only down 0.06%, so that's at least a good sign that they were basically able to keep flat today. On the downside, it was once again energy. I mean, we saw that crude oil chart here a moment ago, and so it shouldn't be a big surprise to see energy stocks like your Chevrons and your Halliburtons and your Exxons and your Schlumbergers and your Apaches. I mean, all those stocks are getting blitzed right now. They just look like death here. And so until we can find some stability in oil prices, I have a feeling that we'll have a difficult time finding stability in the oil stocks as well. And today's price action kind of confirms that. All right, so with all of that out of the way, let me come on over here now to the charts. I'm going to pull up chart 3A that we use in my dividend growth investing class. And this is the chart right here of Johnson & Johnson over the last 10-year time period. So this is a 10-year weekly candle chart, okay? So when we're looking at this, there's a couple different things going on here. The line that I want you to focus on for this conversation here tonight is this blue line. You see a blue dividend stair-step line kind of eking its way higher on this chart. As you can see, Johnson & Johnson has had very good performance over the last 10 years. In fact, it was just hitting all-time highs here 3 weeks ago. My, oh my, how the mighty have fallen once again. And in this particular case, it might have been self-inflicted wounds to some degree, because it wasn't just Johnson & Johnson falling with the rest of the stock market in the last couple of weeks. Of course, many of you have heard about their baby powder scandal going on right now, and how there were allegations that a few decades back, Johnson & Johnson had asbestos in their baby powder products, etc., etc. Well, of course, that type of news, particularly in a market that has been as skittish as this one, will send a stock's price traditionally lower, and that is where we find ourselves with Johnson & Johnson. But interestingly, Johnson & Johnson has not sold off enough to make it overly attractive as a dividend investment for the long term yet, at least from my perspective. One thing I want to point out to you here on this chart is that Johnson & Johnson, about once per year at a minimum, has a 3% yield. We actually had it earlier this year. How do I know that so quickly? When you look at this chart and you see all these price candles come down and touch this blue line like it did right here that I'm kind of circling on the chart, that would have been back here in about May and June of this year, back when it was priced at around $120. That represents where the stock needs to be at its current dividend rate to have a 3% yield. Now, this blue line is going up over time because, of course, Johnson & Johnson continues to raise its dividend over time. Remember, Johnson & Johnson is one of those dividend kings, a company that has raised its dividends for more than 50 years in a row. Pretty impressive feat there. Well, you'll notice that they hit that 3% level here earlier this year. They did not hit it in 2017, which is very rare, but in 2016 they hit it there, 2015 they hit it there, 2014 they hit it there, 2013 they hit it there, and then all of those prior years they were trading below that blue line. So really, out of the last decade, there was only one calendar year, that would have been 2017, where Johnson & Johnson did not have a 3% yield. So while it's true, Johnson & Johnson has certainly taken some punishment in the stock market due to this scandal, their stock price is still relatively elevated for those that want to take a long-term position. So what I thought we would do today for this trade application example, considering we have this very rare weekly cluster on the S&P 500 that we haven't had since the exact bottom of the stock market back in 2009, is do a trade that is considered somewhat bullish. It's not overtly bullish, it's not radically bullish, but it is somewhat bullish, and that is known as selling a put. And so what we're going to do is we're going to come on over here to the trade tab. We're going to look at Johnson & Johnson January timeframe. These are the monthly contracts, the normal monthlies. Right now there's 29 days until expiration. Now notice the 120 strike right now appears to be kind of within striking distance of getting a 1% return on risk. Right now, they've really widened out these bid and the ask prices here after hours, but you can see that the last traded price for that contract here today was $1.59, which would be well over 1% of that 120 strike. So if you're somebody that's sitting here thinking, boy, I'd like to lock down Johnson & Johnson in a long-term portfolio, and I think that this recent news story is being overblown, and you're looking at attacking Johnson & Johnson from a 3% dividend yield perspective, which we're not at right now, right? We're at a 2.81% dividend yield right now. Well, selling a put could open up that door for that possibility. It doesn't guarantee that it'll happen. It's just saying that you're putting yourself in that position to be willing to buy 100 shares of Johnson & Johnson at $120 per share if its share price continues to fall in the coming 29 days. Now, it's currently priced at $128, so it would have to fall another $8 per share in the next 29 days for you to be able to then be put that stock. But, if it doesn't happen, the benefit is you get to keep the credit that you're receiving up front. You're going to receive, let's call it at least a $1.20 for selling that contract. So that's $120 in your pocket for your willingness to buy Johnson & Johnson, 100 shares of it, at $120 per share on the January expiration. So let's go ahead and place that trade. I'm going to click on the bid price there. That loads up our order down below here. I am going to adjust this to at least $1.20. We should probably get filled at a price better than that when the markets reopen tomorrow, but we'll put it in there at that price nonetheless, and we'll confirm and send it. We'll review it one last time. There's the $120 that's coming into our account as we start this trade off. So we'll go ahead and fire that off and see if we can get filled first thing in the morning. All right, well, I want to thank you for joining me here tonight. It's the holiday season, and David and I will be taking a little bit of time off here, so we'll miss you guys. But hopefully you'll have some opportunities to spend time with loved ones, friends, and family. I know I've got family coming in here tonight, and should be a fun holiday season there. Don't obsess too much over the stock market. I know it can get you down, but remember to focus on the things that are truly important in life. And with that, I want to wish you all the best of success with your trades and investments. Goodbye for now.